Hi, everybody. Welcome back to the channel. And we are here with a pop-up podcast. So this is kind of exciting. We've never actually really done one of these. So we are not officially back for season 3 yet. In a couple weeks, we will be. But we did want to come on and give you guys something that we've been working on in the back end a little bit. And it kind of just correlates with our ICT course that we just launched. Lots of excitement about ICT, the course in general, but also just out in the YouTube world. If you haven't heard of this yet, it's pretty trendy right now. It's
You're
like the
living
cool
under a
kid.
rock.
Yeah, it's the cool kid thing to do for sure. And we've been working with some of this stuff. And actually, there's some ways that we think that you could simplify, work with it. And we, of course, backtest. If you guys haven't figured it out by now, we like to backtest and prove probability. Is it going to be profitable? Is it worth using? So, of course, when we heard about all the hype about this ICT, we're like, well, how can we test it? So Jay and I were working on something a little bit, and it's definitely not pure ICT silver bullet. So all of the people who are out there trading it already, please hear my huge disclaimer. We are aware this is not the perfect rules for it, but it is very much inspired from it. And it was our way of taking it and saying, how can we make this less subjective, because it is a little bit subjective when you're using analysis, and more objective, where we would say this is rule-based. You just check off the rules all along. And what would it look like worst case scenario with no analysis? We always, always, always preach analysis first. That is why you have the courses. You should be learning everything else with it. But of course, the backtesters in us want to know, if we have a full-on brain fart day, what would worst case scenario be if we couldn't remember how to analyze the charts? So we always like to kind of look at that, especially when we're looking at producing content for the masses, for all of you guys, because everybody's at a different place in their trading journey. Some people know analysis really well. Some people are just starting out. So we want to know, what is baseline situation? So we found something that we think looks pretty promising for you guys and definitely is inspired by the silver bullet strategy. You want to know how to trade that exact strategy, please use the link below. The guy who created it, he's linked below. I am giving him credit for that. This is a total twist on it and is definitely inspired by it, but it is not silver bullet. We are aware. Don't come hard at us. We know. I know that some people out there will say it. Jay likes to call it, our
Wooden
twist
stake.
of it is wooden stake.
There's multiple ways to kill a vampire and trade.
It's just his dad joke, but it is not officially called that. Don't worry. But we will be showing you guys this version, and we'll show you the strategy, which Jay will get into, some rules, and some back testing with it. So hopefully this will help you guys kind of get started. If you also want to know more about ICT in a little bit more of a condensed down version, all of his stuff is free. You can go look at it, use the link below. If you want the condensed down version, though, we do offer the course now in TTF, which is, in my opinion, honestly, really great. I really do love the way that Artie organized this course. I think it's really well done. We also have a really cool workbook, which I'll show you guys in a minute. But I definitely would suggest either taking his stuff and going with the stuff that you can get on YouTube with the link below, going through his content and figuring out some of the basics to kind of put all the concepts together. It will just enhance your win rates with this strategy. Or you can always join TTF and use our course that we have for ICT that's already there, and then we'll use the workbook and all that and learn those basics as well. And then applying the concepts you're going to learn with that, plus I think something like what we're about to show you, again, taking it, customizing it, maybe even making those win rates higher with your own analysis, I think could really be something cool that Jay and I are definitely going to be working with more in the future. Jay, especially because he's going to be live streaming a little bit more with the ICT type of stuff in the community. So I'm excited to see how this develops and progresses. But yeah, with
Maybe
that being
ICT and astrology. But
stop. He's kidding. He's totally kidding. I think. I think you didn't laugh.
maybe.
He didn't laugh. Oh no. Anyway, I think I'm looking at him tell me you're kidding, Jay, but it's okay. I'm pretty sure he's kidding. But nonetheless, before we get into it, I'm going to hand it over to him in a second. I just wanted to give you guys that update. We will be back for season 3 soon, but in a few more weeks, we have Strategy Wars coming up. And so that's a little spoiler alert. If you guys don't know that and you like Strategy Wars, I know there's some people out there who like to come back just for Strategy Wars. That will officially be starting July 1st. You will be seeing a promo video coming out very shortly. So you can see that coming up for July 1st. Once we're kind of in the process of Strategy Wars, we will be resuming season 3 of the podcast. But we wanted to give you the pop-up version here because I think this is important. I really think people could do some really cool stuff with it, and so did Jay. So we wanted to get this out to you guys. Also, I've never taught you guys something called fair value gaps on my channel. So with that being said, I'm going to show you a snippet from the actual course that we have in TTF. And it's just because, like, why reinvent the wheel already covers it very well. And that way you can kind of see like what the course would even look like and if it's something you'd be interested in. But he's going to teach you what a fair value gap is. And I want you guys to listen to this because this is important to understand what that is if you don't know what it is already, because you need to know what that is in order to understand the strategy that Jay's about to tell you. It's super simple, very easy concept, but please just pay attention for like 1 minute so that way you'll know what it is that you need to be looking for when we get into the strategy part in a few minutes. So let's get into this part. All right, here we are. So this is a back end. If you guys are not part of TTF, you probably don't see this very often, but this is what the back end of our education center would look like. And just so you guys kind of have an idea of what you're even looking at here on the screen, what you're seeing is just our courses. There's like a bunch of stuff you can go, you can kind of read. But nonetheless, where you are going to be looking if you're looking for the ICT course is under our additional courses tab. And then you're going to click on the inner circle trader. That's what ICT stands for. And then I'm going to just show you a clip, but you can kind of see all the different videos. I mean, the course is pretty long. All of these videos belong to that. The other thing I will show you, which I think is pretty cool, is our workbook that we have for this. So there is a tab. When you come into the course, it'll be like under ICT course workbook. You can click on that and then you can download it. And I mean, I'll scroll through very quickly, but you can see there's just tons of pages, charts. There's lots of ways to test your knowledge. There's like practical application of it. There's little tips and tricks about things. I mean, this thing's like pretty awesome. I really love the workbooks that we've been doing. We also did one of these for price action course that we have. And as like a like my knowledge when it comes to learning, like I'm definitely a visual and like practical application person. Like I'm a hands-on learner. And I think sometimes with trading, because everything's like over the computer, it can be kind of hard if you're that style learner. So I love the workbooks. Like I think I like passed all my college exams and stuff because like I would just take practice questions and stuff all the time. So if you're one of those learners, highly, highly recommend the workbook. Especially if you need like that little baby step between like learning something and then going into the charts, full on going into the charts. The workbook is like chef's kiss to me, I think is awesome. Definitely an awesome, awesome thing, I think, that we offer. All right, let's listen to what Artie says the fair value gap is.
Liquidity void. Now, let's discuss a fair value gap. When price has an aggressive price movement up, and you see these areas, and they always happen in sets of 3. So if you focus on right here, the top of this wick, the next candle is where the gap is created. The third candle in this sequence, the low of this wick, the difference between the price of this low and this high, meaning that price was not filled here to the sell side, it only had buy orders in this direction. This right here is known as a fair value gap. When price has aggressive movement up and starts to retrace, it will usually retrace to the fair value gap. Looking at the price movement up and then a retracement down, seeing that this is the 50% level, you are in an area of discount. A discounted area is where buying occurs with a trend continuation if it is bullish. So looking for these fair value gaps in these discount zones is what you want to be looking for with your trade entries. Next up, we have liquidity voids.
And that's enough. We don't need to learn about liquidity. All right, so we are just learning about that, and I'm going to pass it over to Jay now, because that is all you guys really need from that. So you kind of got a little taste for what fair value gap is. You're going to see it a little bit more. So Jay will explain what he's seeing on the chart too in the actual markups that we'll show. But I wanted you guys to understand that because I know I've never personally taught that on my channel, and that way you don't have to go searching and Googling what it is. So that's what the course would look like. That was a little teaser. You're welcome. You learned what a fair value gap is now, and Jay is going to take it over from here and show you guys the rules or the strategy that we have been kind of working on, his version of a silver bullet, and also the data that goes with it, because obviously we backtest it. And again, big disclaimer, it is not silver bullet. So please, ICT traders, it is inspired by it. It's to kind of use the idea and the concepts that are taught. We know it is extremely simplified and there's so much more that goes into it. That is what the course is for. That is what the lives are for. That's what the community is for. There's lots of people who will build on this. This is simplified, very easy, testable version for us to be able to show in a generic way. Also, it works on any time frame. Fair value gaps print on every single time frame, on every single pair. They are always happening. So you can take this concept, because we will show you 5-minute backtesting data that we've been working with, but you can apply it to any time frame. It doesn't matter. It's just the fact that you're looking for those gaps, and then you would be looking for the market to be refilling them when price comes, like when they push up and then price comes back to them. Okay, so let's get into this, Jay.
All right, so now that we got rid of all the big disclaimers, all the elephants in the room, let's get into the meat potatoes of this. So starting from the top, for Forex and gold, I traded from 8 to 11 UTC -4, which is New York time. That's the beginning of New York, and 3 hours after that. Obviously, silver bullet is from 10 to 11 during the New York morning session, but I'm extending it just to see. Like, we didn't get enough data, but maybe some hours are a little bit better than others, sure. And then for indices, I did from 9:30 to 11 UTC -4, again, New York time. 9:30 in New York time is indices open, and then you just trade that an hour and a half afterwards. Okay, so general rules, like Christy had stated, we took the very simplified versions of ICT concepts and put them in like what can be fully objective. What is worst case scenario if you don't do any multi-time frame analysis, if you don't even look at the 4 hour, the 15 and say, hey, it's going bullish, I should only look for longs. If you don't do any of that, you could just literally stay to one time frame, and it as of the last month, it worked so far. So step one, what you want to do is you want to identify the high and the low of the previous London session, plus the last couple hours of Asia. And so in this case, it is midnight time to 8 a.m. New York time. So you want to mark that up, and I'll show you soon how to do that. So step two, you want to wait for a liquidity grab, either the break of the high or the low of the previous session. It doesn't have to be a break and close. It could just be a break. So like, as long as the wicks break above the wicks of the previous session, that counts. We're not looking for that break and close like we normally do. So make sure you drill that into your brain. So for step three, if the previous session does not break, then you simply do not get a trade. You don't get an entry. Just pack up and move on to the next day. There will probably be an entry there. If it does break, then move to step four. Step four, you will now look for the first fair value gap. Thank you, Artie, for explaining that very quickly. To form in the direction of price reversing back in after the break. Probably doesn't make sense all that much, but I'm gonna give a small example, plus I'm gonna show you buy and sell options soon. So in this example, let's assume that price breaks below. Let's say this is London and price breaks below in the New York session. And so now we're gonna look for a bullish fair value gap that forms back up here. So that's what you're looking for. Step five. Once the fair value gap forms in the correct direction, like in our case, it broke below the previous session, and now we're having a bullish fair value gap, what you're going to want to do is look to enter about 25 to 50% of the way of the gap, of the fair value gap. You're basically just waiting for the retracement to happen to get tagged in, essentially. Step six. So this step, we try to make as objective as possible. Obviously, there's sometimes in indices where it doesn't make sense to go all the way back to the swing, but please exercise your own precaution. Like usually if it's if it's a huge gap, like in your stop loss, if it's like 100 plus pip points on the 5-minute time frame, please just understand it's probably too big. But majority of the times though, you'll be able to place your stop loss in this bullish example, like I've just stated, at the swing low that broke the previous level. That's the safest place. The safest place is putting it under that swing low that broke the previous zone and grab the liquidity. And ultimately, your take profit, you want to at least be able to target 1R. In our case, you know us, by the way, we're the default 1.5 fixed rate, but you want to make sure you at least are able to get 1R. You look left and see where the nearest liquidity is. You can target the opposite side of the zone, so in this case, the previous high, et cetera, et cetera. There's plenty of ways to go about that. Okay, so there are specific rules here tailored towards indices that I kind of found, and it just doesn't make sense to go much lower than this, especially rule 1 in this case. No smaller than a 5-point stop loss I placed on S&P 500. There was a couple cases where it was smaller. You just start to kind of, it's too small in my personal opinion. Granted, you might be able to find a system that works for you, but it's very dependent on what broker you're able to have. Usually you can get like a 0.5 to almost 0 spread on S&P, but others, it could be upwards to 1. So I wouldn't go anything lower than a 5, especially on the 5-minute. That's just my personal take. Obviously, use that in your own way. And step 2, if you get a break and a valid directional fair value gap, form after London for indices, because there's technically a gap from 8 a.m. to 9:30. There's a gap where you don't trade that indices when you do for Forex. If you get a break during that gap and a fair value gap forms, if it doesn't fill until indices open, that is good to go to take for your fair value gap. And the last thing that I want to do that I didn't put in here is that we're only taking the first fair value gap that forms after the break. We're not chasing, because you'll see soon that price just literally trails, where like it might not retrace, it'll form another fair value gap, not retrace and keep forming fair value gaps. We're simply going after that first fair value gap. If it never comes back to it, we never get into the trade. We're not like building off of, well, this fair value gap didn't hit, but this one formed. Now this is the one. We're not doing that. So that's kind of an objective way of like, we're sticking to the first fair value gap that forms after we get that break.
Granted, this is generalized backtesting that we did. These are generalized rules that we put in place for ourselves to backtest. You guys, please feel free to do that. Change it up if you want. However you would want to like customize this potentially to yourselves. This is just to give you guys an idea of somewhere to start at and like how to even get into this. If you feel like when you're watching the examples, you're like, that seems pretty simple. So this is just what we found to be the best for us when we were looking at it, and that made sense to us.
There's definitely better ways of going about it, but that the better ways include subjectivity and experience and skill of the trader. And we're trying to like lower this down to where we have a foundation that is as objective as possible and still profitable, which this technically was in the last month. That way, this is a worst case scenario. You build off of this. You use actual analysis and you'll be able to filter some of those losses. So now what we're going to do is get into some of the charts. And so I have the simple sessions indicator. If you type in simple sessions by TTF, aka us, the trade floor, it's a free indicator, and it allows you to put sessions on your chart specifically to their direct time zones. And also it allows you to do a user-defined custom session too, if you don't want to really use any of these and want to define your own session, which I did here.
Which you should do if you are doing even silver bullet. Something like this is helpful. So you can just see that only during those times where that's the only time you would even be looking at. Everything else is just trash if you're following that type of strategy. So don't overwhelm yourself with everything else that's going on, just what's happening during that time frame.
I actually did that with this chart here. As you can see, the different kind of colors of beige. I added a second simple sessions indicator where I simply denote the silver bullet times for the AM and PM New York sessions. But the first simple sessions, I just have the normal Asia, Tokyo, New York mix and like New York only time zones. But with that being said, let's go into replay mode and just kind of show you how we'd go about this. And so this happened on Thursday. As you can see, I'm using the fair value gap. If you type in FVG and it's by Nephew Sam, free indicator, I'm doing nothing different with it. If you go into the settings, there's actually a setting that helps in backtesting. If you come here, delete boxes after fill. If you uncheck that, you'll be able to see every single fair value gap. If you check that though, as you see, a lot of fair value gaps that got filled will go away. So this is just an easy way to backtest if you don't delete those boxes that already got filled. So with that being said, let's do some testing. So we are on S&P 500 on the 5-minute time frame. We did everything on the 5-minute time frame, and we're going to wait until 8:30 forms. I am on UTC -5. Let me make that clear to not confuse anybody. I'm on Chicago time, but ICT always does New York time. So what had happened? Well, we look at the previous session, which I had said, which is London plus a couple hours of late Asia. I just marked this. I denote that as all green. And what you're going to want to do is before 8:30 happens, you want to mark lines at the highs and the lows, and we're denoting it all the way at the bottom. So like the wicks, so like this wick down here and this wick above here. So during this gap where we're not trading indices, as you see, price comes and grabs this liquidity down here. And so once it breaks below, now we're looking for the first fair value gap to form. It forms here, and we'd be waiting for this. But there's another rule. If the first fair value gap forms within this dead zone where you're not trading, you can use this. But if another one forms and you're on the open of indices, like in this case, I would still use this as the first fair value gap form because this is closer to the actual indices open price. So this is the only, I swear guys, I think this is the only time this happens. This is the last disclaimer. This is technically the first fair value gap, but this is the first fair value gap of when you could potentially trade. And it's the one that actually closes during the open of indices.
What he's saying essentially is pick the most recent one. If you're coming on for the day to start your session, your little micro session that you're carving out for yourself during these time frames, even though it did technically happen a little bit sooner, what he's saying is like pick the most recent one. So like if it's happening right before your session is about to start, pick that one. That's the one you want to go with if the fair value gap has happened prior.
This
Even though
only
the other one
happens
didn't.
in indices. Forex, you obviously start at the beginning of New York, but indices is kind of like a weird kind of thing where you have a gap between when London close with like what they call London and what they call indices open. So yeah, Christy explains it perfectly. That's probably a better way to say it. It's like you use use the first fair value gap that forms basically when the session starts. It forms obviously down here, but this is the first one technically of the session. And so from here, what you'll be able to do, you get the fair value tap right before the session opens, but technically, if you want to be technical, 8:25 candle close in the 5 minute is 8:30, and so we're in here. So TradingView doesn't show it all that great, but we are in this trade. You could put your stop loss all the way down here at your swing low. I wouldn't recommend that heavy of a stop loss, but I would actually personally, I'd put it somewhere up here, but sticking to the rules.
Yeah.
You put it down here. Yeah, no, we're sticking to the rules, please. You put it all the way down to your swing low, and then you target this 1.5. Personally, this is a heavy stop loss, even though it's only it's 15 points, which is kind of heavy for the S&P. Usually you want to kind of stay around 5 to 10, but it still works out anyway, because as you see here, it's almost a 1-to-1 on the opposite grab, and we win the trade. So let me go over this.
Well, I just want to touch on sorry, Jay, I don't mean to interrupt you, but I just want to touch on the stop loss. We are sticking to the rules again, but Jay and I are both looking at this like, yikes, we wouldn't take that big of a stop loss on this. Yeah. And this is where you guys, while our backtesting is great, and it's great as a foundation for you to even become interested, to look at the numbers, see if it's worth your time to even look into something like this. Please make sure that you do your own backtesting with your own eyes, your own analysis, because that's what's going to be more predictable for your own trading. Because I wouldn't put my stop loss there. Both of us would put our stop loss a little bit smaller than what you have there. Liquidity was already grabbed. I don't need to be all the way down there. That liquidity has already been filled for me. So you could be a little, in my case, when I'm looking at this, obviously everybody would feel a little bit different about this. Again, that's where your own personal back testing or journaling is going to help you have a better idea of what your own specific numbers would look like. But you can also have very nice numbers because you're adding in your own analysis. So keep that in mind. But yeah, this looks heavy. So I know people are going to be like, golly, I would never take that large of a stop loss potentially. We're saying we probably wouldn't either, but because we need to stay very rule focused, and if we're saying swing low or swing high or most recent high or recent low, we stick with that rule to see worst case scenario. So just so you guys understand.
So the next day, actually that happened, we're going to look at a sell opportunity. What we do is, anywhere between 7 and 8:30, you basically have time to draw these zones because it finished, which is kind of nice. You kind of have like a little kind of a breather before everything happens. And so as you see here, we mark the high and low of the London plus a couple hours of Asia session. We get our price break here, and so now we're looking at the fair value gap set that are going to form whenever 8:30 comes around, which is here. And so we'll go candle by candle now to go a little slower. You see here, this is the first fair value gap that forms. Since we broke above, we're looking for a bearish fair value gap to come back and target that and target the downside. We're trying to come back into the markets. We're basically playing the fake out of the London break instead of the breakout itself. You could think of it that way. So we get the break, price comes down, and now that we're in the session, we're good to go here. And so as you see, price comes down here. we get an opportunity where we enter the trade here. We put our stop loss. It's kind of hard to see. So let me actually delete bars that are already filled. Well, yeah. So it's hard. It's highlighted in red. It's not an easy red to see, but as you can see, this is here. And so I would go about 25, like I said, 25 to 50%. So anywhere around here, this 50% technically is filled in fair value gap land. And so I would target 1.5 like we have. We could do that. And what I've said before, target the recent liquidity. You can see liquidity is right here. So that's just a random example of what I mean by target like the most recent liquidity, as you see like the little swing. Or you could target the opposite side, which you get about a 1.7 in this case here. But ultimately, like I said, we just did a fixed 1.5. And so let's see. We get tapped in at this candle here. Price gets super close. And ultimately, we win this trade. It was cool. So now that we've seen a buy and a sell, let's kind of get into the stats now. And here
it really is. Oh, sorry. I was going to say, it really is that simple. He showed S&P. He just showed you 5-minute. Again, it's the same thing. It doesn't change. The only thing that might change is just the times that we were working with, because S&P is an indice technically. And when you're looking at the Forex pairs that we're going to show you in the data, and then when we look at gold that we'll show you in the data, those are going to go with the original times that were on that list of rules. Again, go back to I'll put timestamps or something in so you guys can see where the rules were. Screenshot them, print them out, stick them in front of your computer so that way you can look at them and you can see the times and all that stuff. But other than that, the actual marking up and entry rules are the same for everything. It's very generalized in that sense. So whatever your thing is to trade, this is how you would do it.
Like I said, we backtested last month really quickly on these specific pairs, S&P, NAS, US 30, EU, GU, and gold. It was from May 16th all the way to June 16th. And we did 1.5 R, 2, and 3 R. And as you can see, here are the stats here.
Yeah, we're aware this isn't a ton of data. So the data people out there also, again, don't come at us. We're well aware. We are showing you what we're working on. We're building on this, and we're going to keep kind of collecting as we go along. But so far, we just want to show you it because people have been asking since we put out the ICT course, is there backtesting data? And this is the data that we're working on currently with it. And we are actually trying to we're going to keep up with and keep kind of collecting as we go along. So we're just kind of giving you guys an idea what's going on here. We will make this available to the people in TTF. I'm not going to put it on YouTube only because it's not done yet. And I don't want to put it out there unfinished. But for those are the people who are in TTF, we'll let you see it as we keep adding to it. So that way you can see the examples as well. So like always, our backtesting has the TradingView screenshots. So I know we only showed you 2 examples of how to enter and exit. But if you need more examples, definitely check out all of the screenshots so you can see why we're entering and what we're doing as far as placing the trades. It definitely helps you see examples for sure. And you can also always ask us in the hashtag strategy support room if you need help with figuring out what's going on with this. But for sure, definitely we'll make this available to you guys in the community so you can watch the progression of it. So let's get into the results, Shay. Sorry for cutting you off there, but I feel like I wanted that disclaimer because somebody's going to be like, there's not that many trades. And we know we're working on it. We're progressing with this.
Yeah, so it actually done pretty well. As you can see here, even at the top with 1.5 R, we had a pretty decent month, like the last half of May into the first half here in June. 2 reward, kind of had some better months, had some worse months, and then 3 R actually did pretty decent as well, as you can see here. So it's all pretty solid, whether you want to do 1.5, 2, and 3. If anything, NAS did pretty well from our testing so far, and it's only been a month, like Chrissy had stated, so it's kind of hard to say. Even EU on 2R and 3R did a lot better than it did with 1.5. So this was just kind of the things that we found so far. The worst drawdown, half month that we found so far was US 30 with -3. But like I said, it's just 1 month. And also US 30 kind of just didn't perform the better, most of them either. So maybe US 30 is kind of cut out of there, but that's okay. We tested multiple here. What I do want to say though is that gold did extremely well. You say 6 and 6, you're like, okay, well, it did 5 and 7 even on 3 reward. And I noticed that these 5 wins, they were runners. I think there was a 13 trade and 2 8-hour trades at the very least. And so from there, what I did was I quickly just sorted by the percent gain. As you can see here, NAS, EU, and S&P we're at the top here. But like Christy said, this is only a month. Do not take this as viable and go run with this. You need to make sure you test this more months back. We just want, like, this is still prototype land for us, but people ask for it, and so we're going to show it. But this isn't finalized. We just want to show you, like, yeah, we are seeing some early success with this, even at worst case scenario, which is always like a good sign for us. So
This is worst case, so you guys are clear. This is worst case, and these worst cases don't look bad.
4-hour trend. I'm not looking at the 15-hour trend. I'm not even taking the break of structure after. Like, I'm not doing any of that. This will simply just break, fair value gap, retrace, enter, bada bing, bada boom.
But that's to say, you add all those other things that really could help you a lot. So definitely learn them. That's why they're in those courses. That's why we teach them. That's why other people are teaching them. Like, they're important. So don't come for us all, the really loyalists to ICT. We are saying that is very important. We are just doing the very minimum of it. And we just want to show that we're showing why there is something valid to this and there is something more, and why you should even put the time into learning that extra stuff. Because this is worst case numbers and they look pretty good. Like, I'm pretty happy with these numbers because this is one pair. Like, say you're trading say you trade EU and I don't know, say you trade EU and NAS, like those are your 2 pairs or something like that. Like, you'd be combining those profits from last month, and like, pretty good in my opinion. I think it looks pretty good. I'm not mad at these numbers at all. I think there's definitely potential. And the runners, like Jay was saying, they ran. So like, if you're using the analysis and also looking at structure and doing all those other things that are properly taught, not just doing the set risk to reward. Again, we do it because we have to stay consistent, but we know that's not what's recommended. So if you're using structure, you're definitely going to see better win rates for sure. So take what we're showing you as like ground to get started, just a nice grounding, and then build on it, do your own testing. And obviously, you don't have to test all of these pairs. If there's only 1 or 2 pairs you personally like, take 1 or 2 pairs and really go deeper with it and see how it's looking for you. But as always, like, this looks good. So you guys, we always are saying to test. I would go in and get the journal out of TTF. And if you like this and you're thinking, hey, this looks pretty nice and simple so far, go learn the course, go get the journal, figure out what works for you, what concepts click, what concepts you think like, I don't need those maybe. And kind of try and tweak this, personalize a little bit, because definitely I like this. I think I might play around with this a little bit too. I know Jay's going to be. So, well, maybe he's not. I don't know. He doesn't know. He's like looking. He's like, maybe not. I feel like you put more order blocks into things.
Yeah,
like,
this is just as simple. This is like kind of training.
Yeah.
For everything. There's a lot more to, like, let me make this clear. Way more than ICT. There's way more about ICT than just this. It's just, we were able to like handpick some of the things that are very objective and put it into a very quick system and be like, you know what, this still works too. And so definitely can be built off of and be a lot better than this, but it requires, like I said, experience, and then also more knowledge of concepts of general trading, not just ICT. Like, so you can use support resistance too. It's not, I know ICT people say that that's a shock, but you can use other things like normal price action, SMC, ICT. You can merge everything together and make this a lot better. I know that for sure. A lot of people are getting like 70, 80 win rates.
Yeah, which is really cool to see. So definitely, like, don't look at this and be like, wow, that doesn't look that great. Again, bare bones. This is like applying no analysis at all. If you are looking for more information about fair value gaps, just go on YouTube too. I know we went through those quickly, so if you kind of are like a little confused, or definitely look into that indicator. It is a free indicator that we suggested to you. It's not by us. It's by, sorry, who was it by again?
Nephews. It doesn't matter.
Nephews.
There's no specific fair value gap. It simply is going to show you. There's no like one fair value gap is better than this. It's just going to show you fair value gaps. Just choose.
I know. I want you to take that one's free though. That's what I want to specify. That person is free. Sometimes they might not. But anyway, there are lots of good free ones. You don't have to go pay for it if you don't want to. So this could be, done completely free. There was 3 indicators that we put on. Jay does put on the extra sessions, but you don't need that. That was just to kind of keep you guys focused on what we were doing. You really only would need 3 at max, which is like a sessions. That's just to keep you focused. If you know your trading timeframes, don't even worry about that indicator. The fair value gap one is free. And The third one, yeah, actually, sorry, there's two because you had three on. Sorry, you had 2 sessions on, so you only need really one. So if you have free trading view, this will work for you as well. So that's why we wanted to put it out to YouTube world for you guys, because this is all free stuff. There's no paid indicators. There's no secret sauce in this. You could do this. Anybody can do this. This is pretty simple type of stuff here. It's really just practicing it and getting used to the marking up and identifying the fair value gaps.
That is all we got for today, ladies and gentlemen.
Yeah. My other suggestion I will just say, though, is that we didn't look at higher time frames. Definitely highly recommend them. Sticking with the overall higher time frames trend will help you. That is taught in ICT teaching. That's taught by us. It's taught by pretty much every profitable trader I know. Will teach you stick with the higher overall trend or time frames, using them as your analysis and then working down to your entry time frame. This was not including that, as Jay said. So if you added something like that in, could definitely help you. Or taking maybe fair value gaps that are trending only in that direction of the higher time frame. That's something else I think that if you played around with some, you might be able to work with those. But again, that adds a little bit of subjectivity into it, and we didn't want to do that. Jay gave a couple of little tips about stop losses, a little bit about that, working with maybe minimums on certain pairs. Like, this is where you guys will have to personalize. If you're on gold, it's going to be a little bit different. You're on indices, it might be a little bit different. We tried to stay very general, but definitely see a lot of potential here. So if you guys are interested in learning more about this, seeing more about it, definitely let me know. We could work on more content for it, show it, maybe do a couple of little live analysis videos if that's what you guys are interested in seeing. If you are in the TTF community, check out the ICT course. It's awesome. I really love it. It's gotten a really good review so far from the people in the ICT chat room, which we have also opened up for you guys. So you guys can go into the chat room too and chat with other people who are trading ICT style stuff. And those people have been trading ICT, and they all said the course is like really good so far. So that's really nice feedback to see, because I'm happy to hear that. The workbook, check out the workbook as well. And I think that's it. At this point, we'll see you guys in a couple weeks. You'll be hearing from us a little bit more about Strategy Wars Season 4 coming up. And as a little teaser, a lot of people have obviously asked about like SMC,
ICT will not be in Strat Wars, but there's something coming up soon.
There is something for you guys. We will give you a competition of some sort coming up.
No, we're not even gonna say anything more. We're leaving you on that cliffhanger. Peace out, y'all.
Okay. Bye, guys.